All right. Hi, everybody, and thank you so much for joining us today. My name is Katie Monahan, and I'm a communications strategist here at the Ohio Arts Council, and I am pleased to welcome you to today's webinar, The Business of Art, Accounting Principles for Artists and Arts Organizations. So we are thrilled to be presenting today's webinar in partnership with our friends at Ohio Dance. And I will introduce those presenters here in just a minute, but before we dive in, there are, of course, just a few housekeeping items that we need to go over. So first, everyone tuning in today is in listen-only mode. This just cuts down on any feedback issues during the presentation, but that doesn't mean that you have to stay silent. If you have a question at any point during the webinar, go ahead and drop it into the Q&A box there in your control panel. We'll monitor those questions throughout the webinar, and we'll be sure to leave plenty of time to answer all of them during the dedicated Q&A session at the end. And if you have audio issues or trouble connecting, we recommend refreshing your browser. And if that doesn't work, try logging off and logging back on. And also, please keep in mind that because we are presenting from our homes, there may be some variations in bandwidth or internet stability. So if the sound fluctuates or one of us freezes up for a minute, thank you in advance for bearing with us. I promise we will keep on rolling. And finally, we are recording today's webinar, and a captioned recording will be available on our webinars page at oac.ohio.gov/webinars and on our YouTube channel by early next week. Oh, and one thing I almost forgot to mention, this webinar is captioned, so if you would like to access those captions, just click on the closed captioning icon there in your control panel. All right, I think that does it for housekeeping. Next, I am pleased to introduce today's presenters, Jane D'Angelo and Jessica Johnson. Jane is the Executive Director of Ohio Dance, and Jessica is an Ohio Dance board member and founder and managing director at Accounting Solutions of Ohio, LLC. And they are here to talk about, as the title of the webinar suggests, accounting principles for artists and arts organizations. So welcome, Jane and Jessica. We are so glad that you're both here. I'm going to hand things off to Jane to get us started. Jane, the floor is yours.
Hi, Katie. Thank you very much. Hi, all. I'm just going to introduce myself. I am the Executive Director of Ohio Dance. I have been in this position since 2003. I am also the project leader and co-director of the Ohio Dance Virtual Dance Collection, which is an interactive website that preserves and documents those that have shaped the dance history of Ohio. I'm a board member of Ohio Alliance for Arts Education. I sit on the chair circle of Dance USA as a former board member. And I have a dance background. I was a soloist with Bill Mackey Dance Theater, as well as studied with many notables, Danny Sloan, Kazuko Inamiko, Nina Alonso, and Tom Marlowe Molinaro, to name a few. I have served as panelist for a variety of organizations, presented at conferences and universities, and I hold a Bachelor of Science in Business from Northeastern, a Certificate of Special Studies in Administration and Management from Harvard, and I'm happy to be here, and I'm going to turn it over to Jessica Johnson.
Hi, everybody. Katie and Jane, thank you for having me today. My name is Jessica Johnson, and I am a CPA. I am the owner and managing director of Accounting Solutions of Ohio. We have been around for just over 10 years. And I've been in the accounting field for a while, accounting and finance. Finance is my background and my passion, and really just being able to help individuals, business owners, nonprofit organizations be able to analyze their financials, analyze their position, and really make the decisions that is going to help them to grow and succeed long term. I'm a graduate of the Ohio State University. And I am the board treasurer for Ohio Dance, also for another nonprofit organization, Look Mono Hands in Columbus, and just have had heavy interactions in the creative and artist space, as well as other industries in Columbus. Our company, we specialize with individuals, businesses, nonprofits, doing taxes, accounting, and contract outsourced CFO services. And I'm just happy to be a resource, and hopefully the information that we provide today will help.
Yes, as you can see that you will have some really wonderful information coming up from Jessica. I'm just going to briefly talk about Ohio Dance. Ohio Dance inclusively supports the diverse and vibrant practice of dance of all cultures and for all capabilities. We advocate at every level of government and every community about the impact dance has on this state's economy, quality of life, and educational attainment. And our current programs and activities, our festivals, conferences, the virtual dance collection, performance opportunities, educational resources, networking opportunities, newsletters, and dance artist services. And now I'm going to turn it back to Jessica.
All right, so if you guys have questions as we go, again, make sure you drop them in the chat and I'll do my best to respond to them. And we can start with deciding if you're an independent contractor or an employee. And so a lot of people have questions on that and what that means and how you determine what your status actually is. So there are a few things to look at. One thing is looking at where you work. Do you work in your own office? Do you go to your client site? That could be something that you look at in deciding what your status is. How you work is something to look at. Who is providing the equipment and supplies? Do you work with multiple clients or do you have just the one? Is your relationship temporary or is it an ongoing relationship? Who is setting your schedule? And also who is assigning the work? So how you work can also help to understand whether or not you should be considered an independent contractor or an employee, and also how you get paid. So are you paid a salary, hourly, or paid on completion of the project? And who is determining that rate? So generally, when you come on with a client, you'll know right away what type of engagement it is. But if you have any questions, then those are some of the things that you'll look at in determining it. And it's not just looking at it as one thing, it's really just holistically looking at the level of control and independence. And the more control and independence you are, the more it's going to lean towards you having that role as an independent contractor. And then there's tax implications of both sides. So an employee will get paid a wage, and benefits will come out of that. Taxes generally come out depending on how you fill out your tax forms, but the employee doesn't have any expenses that they're able to write off. We used to be able to have a chance to write them off, but with the tax changes that came in 2017, that went away. So it's really hard for employees to be able to write off business expenses or expenses that they incur while on the job. The tax return for an employee is a lot simpler. However, for an independent contractor, you get paid by selling your service or your product, and you usually would not have taxes withheld from that pay. An independent contractor, though, can deduct their expenses, and so that reduces your tax liability. And then an independent contractor not only has the standard income tax rate, which an employee also has, but you have your self-employment taxes. That is the share of Social Security and Medicare taxes, where when you're a W-2 employee, your employer pays half and the employee pays half. When you're self-employed and an independent contractor, you pay both sides of that, and that rate is 15.3%. As an organization, if you're an organization or if you also employ or have contractors, you need to pay those W-2s or provide the W-2s to your employees and pay those taxes through your payroll processing company. And if you have contractors as an organization or as a business owner, then you will also need to issue them 1099s if they receive more than $600 from you in that tax year. Both W-2s and 1099s are due by January 31st each year. So once you determine your status, then we have to look at how to process the taxes from there. And if we can go to the next slide. There are common tax types for businesses. Some of them include payroll tax, sales tax, income tax. So payroll tax, again, are going to be those taxes that come through processing payroll. That is going to be your Social Security, your Medicare taxes, and unemployment. Sales tax is the tax that you pay or that you withhold and charge your client for products and some services that are provided. So depending on the state you live in, you may be required to remit sales tax to your state. And you would just want to check in when you create your vendor's license if you have a requirement for sales tax. And income tax is going to be your federal, state, and local requirement to pay tax on the net profit of your business. If you're an independent contractor, sole proprietor, you are still considered to have a business if you are engaging in activity for a profit. And so the federal requirements, they're going to be dictated based on the business type that you have, and state and local requirements are going to be governed by each state and municipality and that you're in. So we'll focus on income tax. And we are now in tax season, and so trying to equip you with the knowledge that you need to be able to effectively file those. There are going to be two major components to processing your tax return, and that's going to be your revenue and your deductions. So on the revenue side, you can get paid several different ways. So one way is having your online merchant and point of sale system. So you may invoice through a system like Square or PayPal or Wix. You can send invoices out to clients. They pay you through those systems, and those systems, either like a PayPal that it holds in that PayPal account unless you transfer it to your bank account, or you'll have something like a Square where it will just automatically send all those deposits to your bank as they settle. There also are payment collection systems like Cash App, Zelle, Apple Pay, those things where you may not invoice them, but you may provide a service or a product and you collect the payment through those systems. And then there's also things like crowdfunding, your Kickstarters, your Indiegogo, those items too. So online merchant and point of sale systems are helpful because they also help to keep track of things because it's all digital and online, and you can check the history through those systems. You also can get paid cash, check, ACH by your clients. So you can have client payments, non-refundable deposits, grant awards. Those are some examples. Grants is important to note because a lot of people think that grants may not be taxable income. If you receive a grant, you want to check with the grantor to see if it's taxable income. Generally, it probably is, but you can always make sure so that you're aware of the implications when you receive that grant. Now, if it's a nonprofit organization, of course, taxes are going to be different. Generally, nonprofits would not owe tax unless you have something that is outside of the mission and unrelated to the mission of the organization. But for independent contractors and businesses that are not nonprofits, then you'll want to check on that for that income source. And then another way to receive revenue is going to be through bartering. So you may not get cash for something that you did, but maybe you get something in return. That is still considered income, and so you'll want to check the status and consequence on receiving that as well. And I'd like to review some of the common tax deductions that artists would have. And so in general, For businesses, there are a few common deductions. Really anything that your business that touches. So any expense that is directly related to your business, more than likely is going to be deductible. You have things like supplies, your cost of goods sold. So if you are selling a piece of artwork, what all went into making that art? And so that's a deduction for you. Advertising, travel, bank and merchant fees, which are like the fees for using the PayPal, the Square, those things. Professional services, your attorneys, your accountant, your studio or office rent, wages if you have them for other people, contractors, business insurance. Those are some of the common ones that you'll see. And then you also have common deductions that are a little more misunderstood. So things like car expenses and mileage. So when you're looking at whether or not you're going to deduct your auto expenses, you want to keep track of the miles that you drive for business and for personal. That is going to help you to determine what percentage of usage you have for your vehicle. So you'll have either a log that goes in your car, or you may have a log that that you keep on an app. So we can talk through some different applications that will help. But that log is going to help you to determine how much you use your car for business and for your personal use. Then you take that percentage. So say it was 50%, you'll take that percentage and you can apply it to your car expenses, or you can take the standard deduction that is determined by the IRS every year. The standard deduction usually is easier and gives a greater benefit. So if you drove 5,000 business miles in the year, you would apply that standard deduction, which is usually a little greater than 50 cents per mile. And you would take that and apply that to your 5,000 miles. So if it was 50 cents, it would be $2,500 as a deduction that will reduce your taxable income. Depreciation is another common misunderstood deduction. When you have equipment, you may need to depreciate it. There are also other items that you might need to depreciate, like leasehold improvements, buildings, asset purchases, things like that. And so sometimes we try to directly write them off and are not able to. There are some special elections that will allow you to directly write them off or depreciate it fully in that year. So when you hear things like a Section 179 deduction or bonus depreciation, those are some of the elections that will allow you to completely write off in that year, but you'll want to talk to your accountant to see what makes the most sense for you. Home office is another one. If you work from home and you have a dedicated office space that is only used for your business or your craft, you also can write that off potentially on your tax return. So you'll want to know the square footage of your home and the square footage of that office space. And same thing like the mileage, you'll take that percentage and you'll apply that to all of the expenses. So your utilities, if you own your home, your mortgage interest, if you rent, you can apply that percentage to your rent. Some repairs, if they impact that office space. So you have an ability to be able to write off your space, even if you are working from home. If you have a loss in that year, some of the home office expenses can be deducted in that year. If they're not able to, you can carry them forward to the next year. Meals used to be called meals and entertainment, and they took away the entertainment side of that. So meals is where you look at taking a client to talk about business, to dinner. As long as it's reasonable, it is deductible. Generally, it's deductible at 50%. However, last year, there was a special election that allowed 100%. So for 2021, you can deduct 100%. When you go into the tax software or when you provide your numbers to your accountant, you'll give them the full amount in any year. And then they will determine what the percentage is, if it's 100 or 50, just depending on the tax laws that are in place right at that moment. Before COVID, they did allow 100% to try to allow people to visit restaurants and support during this pandemic. And charitable contributions is another one. So charitable contributions are great deductions, but a lot of business owners think that if they give to a business, it is going to offset their business income, and it does not. The charitable contributions go onto a different tax form. And so if you are a pass-through entity or a sole proprietor, pass-through entities or S Corp or partnerships, then your charitable contributions go on what's called your Schedule A. And that's where you show state and local taxes paid, your charitable contributions, mortgage interest, property taxes, and your medical expenses. So if you have enough things that exceed the standard deduction, which is the common deduction that they allow anyone who files a tax return, then you can deduct it. But a lot of times, the charitable contributions, if it's not significant, it doesn't end up deductible on the tax return. So it's just something to think about. It's still great, still definitely support the causes that you feel passionate about, but it's important to just understand how that flows through onto your tax return. And then insurance and retirement are other great ways to reduce your taxable income and also plan for your current situation and your future. So there are several different retirement types. For self-employed, you can have IRA, what's called an IRA. You can have a solo 401k. You can have a SEP account. You can have a defined benefit plan. So you'll want to talk to a financial advisor that can help you understand and navigate what plan works best for you. All of the different plans have different limitations on how much you can put in any year, which is usually determined by IRS guidelines, and also how much you make. So a lot of it is determined on how much your business does and the percentage of the income that the business brings in. The IRA, that one, if it's a traditional or a Roth IRA, you can potentially deposit in it, and it doesn't base it off of your net profit from your business. But again, you'll want to kind of talk that through with your financial advisor and also possibly your accountant to see what's going to make the most sense for you. When we talk about traditional versus a Roth, traditional gives you the tax benefit now. So if you contribute $5,000 to a traditional plan, then that will reduce your taxable income by $5,000 in that tax year. There's also something called a Roth. The Roth IRA or 401k, the Roth gives you the benefit down the line. So with the traditional, it reduces your taxable income now, but when you pull out the earnings 30 years from now, then you also have to pay taxes on anything that has grown in the account since you put the money in. For the Roth, you don't get the tax benefit now. However, as that money, that $5,000 you put in, as that grows year after year, once you become retirement age and you pull the money out, you don't have to pay any taxes on those gains. So again, depending on where you're at now, where you believe you'll be at when you retire, those are things to consider. What is the best option for you? Or it's possible that you may be able to do a blend of both. So each option is going to have its own limitations. You also would want to consider health insurance. So if you have W-2 income and your employer allows you to have health insurance, to be under their health insurance plan, then it would just come out of your paycheck, and that's all you have to think about. As a self-employed person that doesn't have that that benefit, you may want to look at establishing your own plan, or if you have a spouse that you can enroll on their plan, then that may be a better benefit. But if you have to enroll in your own plan, then you have to look at things like healthcare.gov or talk to a broker that can give you some options on what type of plan will work best for you. And so there may be options where you do an HSA, which is a health savings account, and that would allow for some additional tax benefits for you. And also just whatever your insurance premiums are for whatever plan you deduct. If you're self-employed, those health insurance premiums are deductible as well. So those are some additional options for you as a self-employed individual. We can also look at some of the keys to success with tax filing. Planning and strategy. Planning is going to be the biggest thing. And so as you're looking at your income, your deductions, all of these things, you should think of how you're going to keep track of all of it throughout the year. Having a good record keeping system is definitely something you want to look at. Keeping your business and personal separate. So you want to have a separate bank account, any account. So we talked about your Zelle and your Cash App. If you have Cash App, it should be a business Cash App and it should be separate from your personal. If you have a Chase account, you should have a business account and it should be kept separate. And you should only be running business items through those bank accounts for the business. When you start mixing business and personal, it really starts to complicate your accounting. And if you ever got audited, it just doesn't look good that you are commingling personal and business funds in the same account. So one great step is having a separate account for the business. Having all of your receipts is also important. So if you get audited, they're going to want to see your receipts. They don't care about your bank statements. They probably want to see the statement. But the statement doesn't give all the information that the receipt does. So you go to a store, you go to Walmart, you can get supplies at Walmart for the business, or you can get groceries for your house. And so if I show a bank statement that says Walmart and I say it's all business, the IRS or whoever's auditing you, they can't validate that because they don't have the information on the receipt. So anytime you make a purchase, keeping that receipt is super important because you want to make sure that you are able to keep that deduction if you were to get audited. There are several different ways that you can do that. You can have like the folder method. And so maybe you have a folder for all your income, folder for all your expenses. And whenever you get those receipts, you just throw it in the folder. One thing to note is that receipts from stores, they fade. So you may want to make a copy of the receipt. One thing that I do is if I go to a store and they allow to print or email, I do both. So having an email gives me an extra backup copy in my email, and I keep all of those emails. I have like an expense folder in my email box so that if I have to go back and look for it later, that I'm able to do that. Shopping at places online help too because you have that history as long as they let you go back. Like Amazon, you can go back and look at that history. And I would hope that if it ever came down to it, if the history wasn't online, you know, as long as it's not too far back, that they would be able to retrieve that from you. But having some kind of system that works for you to make sure you know where your receipts are if you were to ever need them is super important. There also are apps that will allow you to take pictures and you can save those pictures. I bank with Chase. Chase allows you to take a picture and you can tag it into that transaction. So to keep it that way. So just looking at different systems and what works the best for you will help you to keep that receipt and keep your record keeping organized. And then we talked about with your mileage logs, using an app, having a log in your car, whatever system works for you. And then you want to have some kind of accounting system that is going to help you manage throughout the year, so that when it's tax time in January the next year, you don't have to go through and add up all the receipts. You don't have to do that all at once because you're doing it throughout the year. So there are a lot of applications. QuickBooks is very common. There is an online version that is typically more helpful, and it integrates with a lot of different systems. Also, Wave app is one that I see a lot of people use, that is fairly user-friendly as well, and it's free. So having some kind of accounting system works. Also, we'll send you a template for tracking it in Excel through a spreadsheet. So if you're familiar with Excel and comfortable with that, that could also work. Other keys to success: having a budget and a pricing strategy. So every year, or right before you start a business, you want to look at, what are my expenses going to be and how am I going to pay for them? So creating that template, walking through your expenses. Do I have rent for an office or a studio that I have to pay? What is that? Write that down on a line item. What are my supplies typically like? And when you have your accounting systems, then you can go back to the previous year and look at, what did I spend that year? Will it look like that this year? So writing down all of your costs, and most importantly, making sure that you put yourself in there. So as a sole proprietor, what you pay yourself is not considered an expense to the IRS. But when you're creating your budget, you have to make sure that you put yourself in there. And so if I need, bottom line, to have X amount of dollars, I need to add that in there so that when I'm creating my pricing strategy, I know how much I need to sell in order to be able to pay for all of these expenses. And so, we write it down. Things may go great, things may not, but at least you have something that you can measure against, and then you can just navigate back and forth as you have different things come up throughout the year. So having that initial strategy session and creating that budget every year and then analyzing it throughout the year is very important. And also determining what professional services you need to outsource. Legal is going to be, one thing that you may look at. Accounting may be one thing that you look at. Really looking at where your strengths are and how you can engage others that are stronger in the areas that you're not, so that you can focus on the things that you do best. And again, as you create that budget, writing those in, because that is important. That is just as important as you paying yourself. And so if I know I need to have accounting software, I need to, engage in an accountant, or I need to have someone who does my marketing, because that is important, putting that in there in the budget and the framework so that you hold yourself accountable and trying to make those things work. Also adding in the systems that you need to be efficient, and really just planning for anything that may come up. Planning for taxes is one of those things that's super important. It will help you to minimize surprises. When it comes to April 15th, that tax return is due, and it's a large amount. You didn't plan for it. And so planning for your taxes is also going to be important. It also will help minimize over deducting. So a lot of times people spend a lot on things they may not need, or deduct things that may have kind of been right on the line of whether it's business or personal, just because we want to minimize the amount of taxes that we pay. The issue with that, especially if this is your only source of income, is if you want to get a mortgage, when the pandemic started, we had all these government grants and things come our way. If anybody is looking at what your profit is for your business to try to determine something for you, if we reduce the profit so low so that we don't have to pay taxes, it doesn't look good to your lenders or whoever else is looking at it. And so you want to be mindful of what you're doing now because it may impact you in the future. When you're trying to get a house, looking at a mortgage, they look at least the last 2 years. So what I do on 2021's taxes is going to stick with me for the next couple of years. So really just kind of looking at what are my long-term goals, and is what I'm doing now going to impact that goal? So it doesn't, if you plan ahead to pay taxes, really try to save in advance on those taxes, it may help to soften the blow when tax time comes. Estimated taxes and paying estimated taxes is going to be one way to help, and it also may be required to reduce penalties. So when you have to pay estimated taxes, which are your quarterly income tax, if you're going to owe the IRS more than $1,000, then you want to pay quarterly. So it's hard to know if you're starting out, but if you have history and you know this is what it's going to be every time, then you want to go ahead and pay quarterly. If you have an accountant, they can kind of help to run the numbers to see if it makes sense for you to do it. And if it didn't make sense the previous year, maybe you just got to that point. So you want to try to determine if you're going to have that liability so that you pay quarterly because you can reduce penalties. Also, if you don't know how much to set aside, you may have to start with a bigger range. So I always advise, if you don't know, save 25 to 30% of your gross. Now, that could be well over how much you actually need to save because so many different factors go into your tax equation. If you have a lot of deductions, if you sell a product, you may have more deductions than if you have a service. So as an artist, if you're selling a product, then you have a lot of pieces to that. However, if you are the product, if you're a dancer or a photographer and you don't have a lot of overhead, then you're going to have a higher profit because you're really making, your business is really paying you, which again is not an expense. So it's a lot of math that goes into that. And if you don't know or you haven't worked with somebody to try to figure out what your potential tax liability is, I usually just say save 25 to 30% that first year so that you don't have that surprise. In the worst case scenario, you owe less and then you just didn't have to use all that money in that cushion that was in your savings account. So, that's always helpful. The other thing is that the payment is due April 15th, but also your first quarterly payment is also due April 15th. So having that big cushion your first year, that 25 to 30% may help you to be able to pay both of those on April 15th. And then as you start paying quarterly, then it's smooth. So now you just have 4 payments every year. Usually it's about the right amount if you plan it out right. And so there's just not a big hit at any point in time. So really just kind of planning to save for those taxes will really help you to succeed in the future and start planning long-term for things that you want to do. Another good point is to look at the filing deadlines. So for the 1040, which is the individual tax return, that deadline is generally April 15th, unless that day falls on a holiday or a weekend. Like this year, it's on a Friday, which is Good Friday. That's not considered the holiday. There's some holiday in DC that gets observed. And so the deadline actually falls on Monday, April 18th this year. If you have a partnership or an S corp, those returns are due earlier, which is March 15th. And if you want to file a 6-month extension, you have to file it by those deadlines, and then that will automatically extend it for 6 months. However, if you owe money, again, if you're going to owe money, The deadline to pay is on those original deadlines. So if you file an extension, you really are supposed to pay at that time. If you don't, then you may have some penalties and interest for not paying. And then again, those quarterly payments, that first one is due April 15th. The next one is due June 15th. After that, it's September 15th. And that fourth one is due January 15th of the following year. I think that's it. We're gonna open it up for any questions. Hopefully this has been helpful. And then we'll also provide some resources in the upcoming days that can also help to supplement the information.
Yeah, I did want to make a few comments. I just thank you, Jessica. It's as you can see, it's very important to have somebody knowledgeable in accounting methods. There's so much to know, and if you're not somebody who knows the rules, it's good to go for a professional. And so I do want to stress the importance of working with an experienced accountant or CPA for individuals and organizations. And as a nonprofit, Ohio Dance has written into our code of regulations to have a lawyer and accountant on our board. So if you are a nonprofit, I recommend doing this as well. And also, whether you're an individual or an organization, make sure you understand budgets. Do not leave the task to the accountant. You want to know what your budget is, as Jessica mentioned. And if you're using QuickBooks, learn how to use it. I share QuickBooks online with my accountant, and that is a nice method to use, an online system. They have tutorials. And that way my accountant can create reports that they need, and those help me in the future. So if you're starting on your search for an accountant, either as an individual or nonprofit, some resources to consider are SCORE. They provide confidential business advice through a network of 10,000 retired volunteer business experts. And this is a national organization. They have locations throughout Ohio. They mentor virtually, but also now I think they're going in person. And their website is www.score.org. Another resource might be going to colleges in your area. Maybe the college accounting departments might have some advice for you, recommendations for accountants, or reach out to local accounting firms to see if anyone might be available for counsel at a reduced rate. You can Google cpadirectory.com, has a lot of, and then put in your region. So, and of course, find out what the fees are for the accountant, what they charge, so that you do not have surprises. And I just want to thank our funders, the Ohio Arts Council, Greater Columbus Arts Council, Columbus Foundation, National Endowment for the Art, Ohio State University, Dance Preservation Fund, Puffin Foundation West Ltd, and Kappa. And now here's a slide for our contact information, email, websites, and we will provide this to you later.
All right, thank you so much, Jessica and Jane. Jessica, that was a lot of really great information and helpful in terms of planning ahead and not finding yourself with some unpleasant surprises down the road. And Jane, we really appreciate your insight as somebody with a nonprofit organization and the advice that you had to offer. So I think now we will go ahead and open it up to questions. We have quite a few, so we'll do our best to work our way through these. Let's see, where do we start here? So we had a couple of questions regarding LLCs and independent contractors. So the first one is it better to start an LLC as an independent contractor if you are doing a lot of work and need to deduct expenses?
So the IRS's definition of a trader business is a trader business that is an activity that is carried on for the livelihood or good faith to make a profit. And the facts and circumstance is going to depend on the activity of the business. You have a business whether or not you have an LLC. As long as you are engaging in an activity to make a profit, and your goal is to make a profit, whether or not you did it, you have a business. The term LLC is, that is a legal thing. So individuals get LLC because it offers some protections on the legal side. You'll want to consult with an attorney for that. But the fact that you have an LLC to the IRS is actually considered a disregarded entity. So they don't care about those 3 letters at the end of your business name. You still have a business whether or not it goes by Jessica LLC or just Jessica. So, so to answer that question, you can still deduct whatever your expenses are for your business, whether or not you have the LLC. You just may want to consider getting it for the legal protections that it does provide. And you also can get an EIN number for the business, whether or not you have the LLC or not.
Great, thank you. So speaking of deductions, somebody was asking, as a dancer or choreographer, can you deduct the cost of things to keep your body moving, such as classes, Pilates, yoga, chiropractor appointments?
I wish. The IRS does not allow deductions for things that also could be deemed to be personal. Another common misunderstood deduction that I probably should have mentioned was uniforms. But in your world, that is a great question, because those things are necessary. You do need those things. You know, you even need certain clothing to wear. But if there are things that you also could use personally, it crosses the line. And so those are all services that other non-dancers could possibly receive. So those would not be deductible. And the same thing, you know, there's a case about a news anchor that says, I need certain hair items, or I need to do certain things to my hair to be on TV, having the hair, the makeup, those kind of things. And it's just not deductible, even though you do know that certain professions do require you to do extra things, but those are all personal. So unfortunately not.
Thanks for the clarification on that, Jessica. We had a couple of questions about mobile apps that you might recommend for record keeping, tracking receipts, mileage, that kind of thing.
So for mileage, MileIQ is one that I see a lot. MileIQ, when you put it, you actually can do mileage on QuickBooks on their mobile app too. But with MileIQ, I know for sure, you put it on your phone and it tracks. Somehow it knows when you're in the car and moving, maybe at the speed that you're moving, but it knows when you get in the car and you go. And so when you make it to your destination, it pops up and you can swipe left or right, whether it's business or personal, and it keeps track of it there. And so it depends on, you know, how aggressive, because again, you're gonna have to swipe left and right every time you get in and out the car. But again, if you're great with technology and you love apps, then that may be a good resource. QuickBooks has a mileage tool on its app. I've never used it. I don't know if it works the same as MileIQ, but that is another resource. And QuickBooks, they also do the receipt tracking. They really try to be a one-stop shop for business owners, and so they're always constantly adding in things. They also offer a point-of-sale system. I sound like a QuickBooks salesperson, but another way, if you didn't have QuickBooks, if you wanted to try to do receipt tracking, Expensify is one. A lot of these things do have costs. I think for MileIQ, I think you get a certain amount for free before pricing would kick in. So maybe if you do under 100 transactions in a month or something like that, it may be free, but you'll just need to look into that. But Expensify is another one for receipts. And really, when you go into your Google Play or your iPhone app store, app center, if you just type in those things, it'll kind of show all the different applications, but those are the common ones that I see. If you can find something that does it all, it's helpful because you're going to be paying for a whole lot of different subscriptions. So if you can try to wrap them all into one, that is going to be more ideal.
Speaking of mileage and tracking, somebody was asking for mileage logs. Can it just be something as simple as a notebook with things written down, or does it have to be in a more formal format?
It can be as simple as you need it to be. You just need to know that if you get audited, you need to know where you drove, like what, the address that you started at, which is going to be your office, and where you went, round trip. If you have a home office, it's easy. You leave the house to go do business. Your commute, if you have an outside office, your commute from home to the office is considered personal, and you can't deduct that. So if you're going somewhere else, you can only deduct it if you're going from the office or if it's further than the distance. If you're going straight from your house and you do have an office, if it's further than that distance that it would have taken you to get to the office, you can deduct that difference. But yes, your mileage log, it could be written on, especially if you don't do a lot, you can just write it on a piece of paper. I think the apps are really helpful if you have a lot of business miles, if you're constantly driving, so that you don't have to write it down. What I used to do is on my calendar, I always put everything everywhere that I went on my calendar and would have the address in there. And at the end of every month, I tried, sometimes it might have been 2 months, but at the end of every month, I would print out my calendar and look at all the places I went and write down what those miles were, and then just total it on that calendar so that at the end of the year, I had each month's totals, and then I would just use that. So it doesn't matter the system. It's just as long as we can get to the end result, which is knowing how many business miles you travel. And the other important piece to note about mileage is you need to know the personal miles. So you're not going to be keeping track of that. You got to know where you started. So look at your odometer at the beginning of the year and at the end of the year. Once you do it one time, you're just at the end of every year looking at it, because your mileage on December 31st is going to be the same as January 1st. So once you track that in 1 year, you're just constantly always just writing that number down, so that if I drove a total of 12,000 miles in the year and my business was 5, then I know my personal was 7. So you'll want to do that. What I've seen in audits, not even necessarily audits, but just sometimes the IRS won't fully audit you, but they'll ask for more information. And I've seen a case where they asked for your, if you got your oil changed or any repairs, they asked for that information. And the reason why is because they put the odometer reading on there. So if you're, say you got 2 oil changes in the year and your odometer, 6 months apart, your odometer only changed 3,000 miles, but you're saying you drove 12,000 in the year, they're trying to see if what you're writing down is reasonable. So making sure that you have a good account of what you're doing is important, so that if somebody questions you, you're able to just pull your information out. So a long way of saying the notebook is okay, if that works for you.
Fantastic, thank you. Got a question. I guess we'll target this one toward Jane first, and then Jessica, if you want to pop in. But Jane, there's a question that says, how are fiscal agents a benefit, like the service that Ohio Dance provides? Can you talk a little bit about that?
Sure. So yes, if you are a individual or an organization that does not have 501c3 through the IRS, then you can come to Ohio Dance and you want to apply for a grant or receive donations. you can come to Ohio Dance, and we will go through a contract and become a member, and then you can apply for grants through us. We are set up with Greater Columbus Arts Council to do that, and we might be able to do it possibly through the Ohio Arts Council. You would need to talk to people at any of these funders first, and that if you do receive a grant, those funds are taxable. So you will receive if it's over 600, you will receive a 1099, and you will have to file those taxes. Jessica, do you have anything to add?
No, and that was a good point. So like Jay mentioned, it really depends on what your fiscal agent contract is. Some agencies will also pay the expenses for whatever you're pulling the income in for. So whatever you get from them is what you'll get a 1099 for. So say your grant is for $5,000. If they give that grant directly to you, then your 1099 is going to be for $5,000. And you're going to want to make sure you keep track of all the expenses that come through that. If they get $5,000 grant and then also pay your expenses for you and give you, whatever smaller percentage or whatever the agreement is, whatever you receive from them is the part that is going to be the taxable income for you. So you just want to make sure that you keep track of that information.
Could a nonprofit be a fiscal agent for something outside of their mission?
I think so. Jay?
I'm not sure I understand the question totally. I guess if somebody is, well, the fiscal, we are a fiscal agent. We can provide this service for people. So I guess if it's not art related, maybe. I'm not exactly sure what they're saying.
It may trigger a 990T unrelated business because you're receiving whatever that percentage is. So it may trigger that if it is outside of what you'll want to kind of look at what you put in your 1023, the application, and talk to your auditor.
Thank you. Let's hop back over to IRAs. Can you contribute to both a traditional IRA and a Roth IRA and receive benefits for both respectively?
Yes. So there are limits depending on what year it changes. For 2022, the maximum contribution to an IRA period is $6,000 if you're under 50. If you're over 50, you get an extra $1,000 to be able to contribute. There are income limitations when you have a Roth. So if you make over a certain dollar amount, which is like $120-something thousand, then you may not be able to contribute. So that's something to consider. But your total is going to be that $6,000 or $7,000. So if you do both, you have to split it in some way. You can't do 6 or 7 to each in 1 year, but you can do that, and you would have whichever benefits. Again, the traditional gives you that deduction now. The Roth helps you with taxes down the road. So you can do both. Also, sorry, again, you'll want to just consult in your scenario, but if you can only contribute, so retirement is based on earned income. If you don't have $6,000, $7,000 of earned income, then which is your W-2 income or your net profit from your business, then you cannot contribute. So that's something to consider too.
Great, thank you. We have a couple of questions related to that $600 1099 threshold that you were talking about. So the first one is, how do you deal with paying someone under $600 then?
So you can still pay people under $600. When my advice is always, if you're going to pay someone to provide a service, get a W-9. It doesn't matter if you're going to pay them $50 now or if you're going to pay them $600 off the top. Because if it's January and I pay somebody $50 and then December I pay them $600, now I got to issue a 1099 and I didn't realize it added up to that amount until it's too late. So whether or not they're going to receive a 1099, whenever you engage in services with somebody that's not a corporation, get the 1099 before you pay them. But you can pay them anyway. My advice would be to avoid paying in cash. Anything that's traceable is always best. I know that's not always an option, but if it's somebody that gets paid under $600 and you're not giving them a 1099 and you pay them in cash, you really don't have a lot to show unless you have them write a receipt or send an invoice. They can send you an invoice and, you know, mark that it was paid. That would help too. You just want to have some kind of system to make sure you keep track, but you can pay people under $600.
Great. I know we're coming up on time here. I'm going to try and squeeze in a few more questions. And then if we don't get to your question, I'm keeping track of the chat and the Q&A so we can always follow up online after or offline afterwards here. But sticking with 1099s, if you receive a 1099 from another organization and you haven't purchased anything, you've just provided a service, is it okay to mix that into a personal bank account?
You can. So it sounds like you're saying you get payments for this one thing, even if it's consistently, but you don't really have a lot of business activity. You can. You know, again, when you separate them, it's easier to keep track. If it's just that, you can. One thing that you really want to note is that you're getting checks from this organization. You still want a way to keep track of the checks. A lot of times, people are emailing asking for their 1099 because they're trying to figure out how much they made. And so you need to know how much you made without getting a 1099 because those 1099s could be wrong. So you want to be able to check how much you actually did make against that 1099. So if you're mixing it into your personal account, just make sure you have a way to be able to separate it out so that you can go and make sure you know how much you made, even if you're just writing it down as you go throughout the year.
All right. Final question. So you talked about barters. Do you need to have an appraisal of the barter?
You need to have a rhyme and reason. So if you give me art and I provide accounting for it, then you have to record whatever the value is for that service. So, you know, if the service that you received from me for the art was $500, then would have normally been $500, then that is your income because you got a $500 service in exchange for your piece of art.
All right, so we've gone a little bit over time today. Like I said, I've kept track of our chat and the Q&A. I have everyone's email addresses, so we will follow up offline. But I just wanted to thank Jessica and Jane again so much for being here. This was really valuable, helpful advice. If anyone missed part of the webinar or they want to share it with a friend or go back and look at it again, a recording of the webinar will be available on our webinars page at oac.ohio.gov/webinars. Oh, I'm muted. Nobody told me I was muted. I am sorry.
Yeah.
So basically what I said was, thank you so much for being here, Jane and Jessica. I apologize for my rookie Zoom mistake there. If you missed any portion of today's webinar, we are going to be posting that on our webinars page within 48 hours. That's oac.ohio.gov/webinars. I'm going to drop that in the chat here. And thank you again so much, Jane, Jessica. We really appreciate you taking the time to be here. Thank you, everyone, for taking the time to tune in. Have a great rest of your week, and we will see you next time.
Bye. Thank you, everybody.